Welcome to The Explainer. Today, we're putting on our financial detective hats. We're not just glancing at market charts, no. We are going to interrogate them. Our main tool for this investigation, a modern adaptation of the Wyckoff method. It's an absolutely foundational approach to reading the hidden story of the markets. So let's just dive right in and learn how to see what the market is actually trying to tell us. I love this brilliant analogy from Dr. Alexander Elder. It perfectly sets the stage for our whole investigation. Think about it. To make sense of the market noise, you have to know exactly where to look for the action. You wouldn't just throw a fishing line blindly into the middle of a lake, right? You'd go to the edges. Well, in trading, those edges are the boundaries of congestion zones or trading ranges. It's right at these edges where bulls or bears become completely, utterly exhausted. And at that exact moment, just a tiny amount of pressure can reverse a massive trend.
Here's our roadmap for the explainer today. First, the origins of the Wyckoff method. Then, where to find trades, followed by the art of drawing lines. After that, channels and trend reversals. And finally, reading the chart's story. Let's get to it.
Section 1. Origins of the Wyckoff method. Richard Wyckoff arrived on Wall Street way back in 1888. And, he didn't just want to blindly follow stock tips. Instead, he spent decades meticulously studying the ticker tape, trying to understand the actual underlying forces driving the market. He realized that a stock's action reflected the plans of the masterminds who were dominating it at the time. By 1910, he published Studies in Tape Reading. But here's the absolute key takeaway you need to understand. Wyckoff wasn't looking for rigid geometric patterns or some simple cookie-cutter setup, not at all. He wanted to build an intuitive, trained judgment. He was reading the raw, unfiltered pulling power between buyers and sellers.
Section 2. Where to find trades.
Now, trading ranges don't always give us perfectly set patterns, but their boundaries get repeatedly tested as buyers and sellers fight for dominance. And the most critical clues? They happen right at these edges, especially during those deceptive false breakouts. We've got two key terms to remember here. First, a spring. That's a false breakdown pointing down below a support line. Second, an upthrust, which is a false breakout pointing up above a resistance line. Once you train yourself to spot the behavior of a spring and an upthrust, it's like a light bulb goes off. Your eyes will be totally open to action signals that work across every single time frame. By drawing out these horizontal boundaries, you can instantly start to see turning points emerging from what otherwise looks like a tangled mess of price movement. Think about the spring down at the bottom of a range. Price dips below support, traps the bears into thinking it's going lower, and then violently reverses upward. Conversely, up at the top, we get the upthrust, a false breakout above resistance that totally traps the bulls right before the price collapses. And of course, you'll see tests of these breakouts and breakdowns. These moments right here, these are your prime action signals. Moving on to Section 3, the art of drawing lines. What's really fascinating is how drawing these lines brings the market's struggle into crystal clear focus. Take a historical struggle where you can trace bold horizontal lines right across a September high and an October low. These horizontal lines, they aren't just arbitrary markers drawn for fun. They dramatically highlight the exact moments where buyers and sellers are going head-to-head for dominance. At the bottom support line, sellers try to take control and drive prices lower, but the buyers check the decline every single time. Up at the top, a resistance line perfectly captures those false breakouts where buyers seemingly had control, but sellers just aggressively turn them back. The lines give the raw price action context. So framing horizontal ranges is absolutely crucial, but as we know, markets also trend. When you're trying to frame an uptrend, creating a precise up channel takes 3 mechanical anchoring steps. Step 1, you anchor the initial low. Step 2, anchor the second low to create your demand line. And step 3, you draw a parallel line across the intervening high to create your supply line. Let's break down what this actually builds. When you follow those steps, you build a very clear channel. Those first 2 points at the bottom create our demand line, and that third point at the top gives us our parallel supply line. This methodical anchoring process creates a dynamic boundary that actually captures the vast majority of the price action. It reveals the true underlying trajectory of the trend. In fact, when the price reaches that top supply line, it often indicates an overbought condition way more reliably than those complex mathematical indicators. Section 4, Channels and Trend Reversals. To really understand trend failure, we have to talk about a famous teacher of the Wyckoff method named Bob Evans. He created this remarkably powerful metaphor called the shell diver's tragedy. He compared a market rising within an up channel to a diver picking shells off the ocean floor. The diver goes down to the demand line, grabs some shells, and swims back to the surface of the supply line to put them in his basket. But eventually, something goes wrong.
The diver falls below his normal depth. He gets a cramp. He tries valiantly to swim to the surface again, but he just falls short and sinks. It's a bit dark, sure, but it perfectly describes a market losing its bullish momentum.
The crucial thing is visualizing this cramp in a real time. Imagine a market attempting to rise back to the top of its up channel, but suddenly it gets that metaphorical cramp. It sinks below the demand line, spelling absolute tragedy for the uptrend. You'll notice how the entire character of the rally changes. It literally can't reach the surface anymore. The trend has broken, and usually a steep down channel immediately follows. It's incredibly helpful to contrast a standard trend continuation with a reverse channel. Picture a normal, healthy up channel holding steady. Then compare that to a situation where the trend lines start converging, which is often called a rising wedge. This usually happens when an uptrend gets incredibly steep. We end up drawing a reverse trend line across the rising highs and a normal line across the lows. When these two lines converge, it acts as a massive, flashing red warning sign of ending action. The market is simply tiring out. When you see prices pushing up into this tightening, converging reverse channel, pay close attention. When prices finally break above or below these converging reverse trend lines, it serves as one of the absolute most reliable clues of a major market reversal. You'll often see a sharp breakdown immediately following the break of that wedge. Honestly, almost no other trendline break has quite this level of predictive value. It's a real game changer.
And that brings us to Section 5, reading the chart story. At this point, we aren't just looking at abstract charts anymore. We are actively evaluating the pulling power between bulls and bears at critical junctures. To do this, we look for very specific clues. We compare the effort of buying or selling against the actual reward and price progress. We watch for incredibly wide or narrow price bars to gauge the ease of movement. We analyze exactly where the price closes within the bar's daily range. We keep an eye out for a shortening of upward thrust as a trend tires. And above all, we heavily respect areas where multiple support, resistance, and trend lines intersect. That's your confluence of lines.
Ultimately, successful chart reading is a study of force. At critical junctures, a feather's weight can shift the entire trend. So I'll leave you with this final thought. Are you just looking at rigid patterns, or are you reading the living story of the lines? The next time you look at a stock chart, I challenge you to step into the detective shoes. Draw your lines, find the edges of the congestion zones, look for those springs and upthrusts, and find the trades that are just waiting to happen. Thanks for joining me on this explainer, and happy sleuthing.